My name is Michael Gaia, publisher of the Lead Lag Report. This is a webinar sponsored by Measured Risk Portfolios, talking about Synth-Equity, certainly very experienced professionals. So I'll let Alex and Larry introduce themselves, and I will pop back in later. Again, folks, for the CE credits, stay to the end of the presentation, and please do me a favor and let other FAs know about this webinar. Alex, Larry, all you.
Cool. Thank you, Michael. Well, my name is Alexander Flecker. I am the Chief Revenue Officer here with Measured Risk Portfolios. I have about 12 years of experience in financial services. I'm a CFP and a CIMA, and I've been with Measured Risk for about 2 years. And it's been a phenomenal 2 years. In my career, I've helped financial advisors, institutional asset allocators, and the like allocate about $600 million into typically what's alternative investments, or at least investments that aren't plain vanilla. And one of the things I like most about working at Measured Risk Portfolios isn't just the leadership team run by Larry here, but I think this strategy is extremely timely, and it can really help support advisors building their books of business and helping overcome behavioral biases for their clients. So with that, Larry, you want to jump in and introduce yourself?
Absolutely. Thanks, Alexander. So I started my humble career as a life insurance agent. So I apologize for that, but some of us get into the business in unusual ways, and that was my way in. But as part of that training,
can I just say, Larry, you want people to stay? I don't know if that's how you want to.
Exactly right. So, it was excellent training. I think the process of working with life insurance it can be both the simplest and the most complex product out there, and it's kind of it became a natural segue into what we do now at Measured Risk. But this process of getting into the wealth management side of things was really more interesting to me than the life insurance side. And so we started to build portfolios. We were early adopters of the ETF model to get exposure to the ETF sectors. And we were using early software that would allow us to optimize the performance of the portfolios and optimize diversification. And then I got my first real taste of, oh crap, the tech bubble burst, and the portfolios that we had built using excellent tools all just started to correlate in their losses, and those losses mounted. And I started to get the first calls where a client would say, Larry, how much worse do you think this is going to be? Or how much more do you think we can lose? And it was miserable because I couldn't come up with an answer. There was no way to answer that question given the holding of diversified positions, because frankly, all we had to go on is past performance. And we were charting new territory, making new data, and that new data was not good. So that was kind of the genesis for trying to find another way of building a portfolio that would be more resilient, and that would provide the assurance to an investor that when things got bad, there would be a known outcome, that we could have some way of saying, well, this is as bad as it can be. And at the same time, not run for the hills and invest in bonds and just get out of equities, because we know the equity story, the long-term growth, particularly with the S&P 500, it's just like the 800-pound gorilla of benchmarks, and super difficult to beat. So how can we build something that would be able to capture that return, but protect us from the actual, this terrible thing that it does every once in a while, which is lose half of its value? We tried many things. We tried trend following. We tried engineered products that move at 2 times the pace of something else. When the market's going down, it goes up 2x or 3x. And all that led to just some dilution of the potential return. Because if you put anything in a portfolio that protects against the downside and the market rises, that generally impedes your performance and it just dulls it down. And that was our result for a couple of years. And then we came upon an idea, and the idea was part of an insurance product. So Michael, despite your comments about the life insurance things, the insurance companies do a couple of things well. And what they had are these, I'm sure now everybody knows structured notes, buffered products. They're all kind of built in different mechanisms. But initially, years ago, we're talking now almost 20 years ago, to run across a product that could offer a credit if the market went up and nothing, like a zero if the market went down, that was like a mind blower for me. How do you do that? And so that's what my partner and I began to investigate. Is how do you build a portfolio that can give an investor a credit if the market that you're tied to goes up, and just dodge a loss if it goes down? That was the genesis for Measured Risk Portfolios. Alexander, you want me to actually do the reveal, or should we go out and save that for later?
Sure. You can talk a little bit about the reveal and how we structure the product.
Fine. So what we do is take a playbook from these structured products, and in the simplest form of a structured note, what the insurance companies do and what the manufacturers of these products do and what the buffer producers do is they rely on the discounted future value of a zero coupon bond. So if a bond interest rate is maybe 5%, it only takes about $95,000 out of 100 to get to $100,000 a year from now. So you deposit 95 today and grows to 100,000. That $5,000 that's left over has to go into something that will give you a credit if the market goes up. And so it's an option on the index. And that once I realized that that was possible, it opened up an entire world of being able to build a portfolio that had some known outcomes to the downside. And that really is the genesis for the Synth-Equity approach. We trademarked that name about a year ago, a little over a year ago. And it's really to emphasize the fact that, in our opinion, the best way to avoid losses in the stock market is to not own stock. And because otherwise, any kind of ownership in stock is going to lead to have some losses. So that really is the genesis for what we do. And so instead of having some sort of wicked clicking skill to be able to sell or buy at the right time over and over and over again, correctly, which I think is, fool's gold, frankly, what we do is rely on a very heavy allocation to capital preservation through Treasuries. And that is the definition of, secure assets. And then we have to spice it up with something. And so in order to get the portfolio to move, we need to go well off the normal path. And we don't want to invest in something as tame as Bitcoin, because frankly, Bitcoin doesn't have enough juice. Think about it that way. The leverage we can get from an option on the S&P 500 is much more powerful than that. And that's what we're relying on. Now, in exchange for that, it means that we can take 100% loss. I don't think Bitcoin will ever go to zero. At least I don't think so, but I suppose it's possible. But our options definitely can go to zero. And that's the part we lean into. We know what the drawdown can be. So we now have two things that we know. We have a defined allocation to the safest asset class we have, and then we have a defined allocation to the riskiest asset class we can find. Now, what that gives us is the potential for no cap to the upside. Because when we own call options, we are entitled to the gain that occurs in the underlying security. That floor on potential losses comes by knowing that the allocation to the options is going to be a defined amount that we manage. And then with active rebalancing into the strategy, we harvest profits in rising markets. And what that does is it takes the gain that we would be developing out of this strategy and removes it from the risk of loss. So if we get an opportunity to monetize the option after we buy it, we sell it, and we don't have to wait a year or 6 weeks or any kind of defined amount of time. We have and will be able to sell the options for a gain if the market pushes the value of the option higher. And as soon as that occurs in a way that is meaningful for and meets our metrics, then we take that gain and we add to the treasury balance. Now, if you're, in fifth grade math, you can probably figure out that if you're taking your gains and moving it into treasuries, the risk of loss in the treasuries is not zero. I mean, there's a potential for a small wiggle there, but it's very, very safe. And so we're removing the risk capital and increasing the riskless or the low risk capital. So, for retirees, one of the things that we built this for is the people that are in their 50s, late 50s, even in retirement, that realize that they need exposure to additional risk. They're kind of shied away from an investment maybe in the S&P 500 because of the risk of capital loss. But when you have a structure like this, you can potentially increase the allocation to risk because we're defining the downside and limiting that loss effect. There's a potential for you to be able to maybe help a client increase their allocation to this, magnificent long-term return engine. We're upside focused, so we want the ability to earn without a cap, and that's what happens with this structure. If there is a rapid rise in the markets, we expect to be able to participate strongly. If maybe sometimes a little bit behind, sometimes a little bit ahead. We're more like, if the S&P is a straight line arrow going through space, we're kind of like corkscrewing around it. We're going to be in the neighborhood of that return over time, sometimes above, sometimes behind, but right in the area. And then for investors who are allocated in a traditional 60-40 portfolio, if you do the math on that, actually people here in the audience, you've probably had clients in 60-40 portfolios. And as recently as 2022, I'm sure the losses were much greater than A, you expected, and B, your clients expected. And at the same time, then following in years like 23 and 24, those portfolios just can't return what the S&P 500 returned. And this strategy allows you to simultaneously potentially reduce the actual risk exposure and increase potential return, and do it all in a way that has a very defined amount of risk along the way, so that there's never going to be an opportunity where you have to field a phone call and not be able to answer the question, how much worse can it get?
Thanks, Larry. That's really helpful. Really what I'm going to go through right now is 2 slides that we like to discuss with financial advisors about how we can position this product for their own clients. We have a slide on fundamentals, high-level overview, slide on technicals. Then we go a little bit further into the options-based category. At that point, I'll turn it back over to Larry, and he'll actually walk through a little bit finer details about how the portfolio runs and how it's built and our expectations. So we kind of start here from the top. Why do we diversify? It stands to reason. The Buffett approach, just simply having a younger investor or somebody with a relatively longer time horizon, whether it's 10, 20, or 30 years, just piling it into the low-cost indices that track, whether it's the NASDAQ or the S&P 500 over time, is going to yield some pretty incredible results. If you look at the S&P 500, since 1990, a $50,000 investment in one of these low-cost indices would have yielded a portfolio in 2024 of $1.7 million. So the question becomes, why do we diversify? If we look at a 70-30 allocation, or a 60-40 or a 50-50 proxied with the S&P 500 total return and the Barclays US Ag, we can see that the performance is significantly lower. And there are some periods of substantial volatility in the mix. So why do we diversify? Why do financial advisors or the wealth management industry exist if it's as easy as simply going out and buying a low-cost ETF that tracks the performance of the index? By the way, which I consider to be the greatest momentum trade of all time, as the index is always adding the winners and the best performers in a larger and larger fashion as they continue to do well, and kicking out the losers and the worst performers as they fall. Well, we all know the reason to that, and the reason is because the hindsight experience is very different than the journey itself. Since 1995, so about roughly the last 30 years, the S&P 500 has demonstrated its one real fatal flaw, that at any time it can give up significant value. We've seen 4 drawdowns greater than 25%, 3 greater than 30, 2 greater than 40, and then, of course, in 2008, greater than 50. Now, clients experiencing these drawdowns have their emotions being pulled on in all different directions, causing them to maybe make some decisions that aren't best for their long-term rate of return. Or if they simply were those investors that bought and held the S&P 500 from back in 1990, seeing 50% of your portfolio fall in a year like 2007 and 8, it's very challenging to stay invested. And I'm sure many of us on this call know that. But we think of measured risk portfolios what's maybe worse than the drawdowns themselves, because you can always go out and make more money. It's the time that you lose waiting for the recovery. It's the sequence of returns risk, because you can't make more time. If we look from the dot-com crash, it was nearly 7.5 years for the S&P 500 to get back to break even from its previous highs. And then immediately followed the great financial crisis, which was almost 6 years, essentially what's now known as the lost decade. COVID was a bit of an anomaly, with upwards of $5 trillion of stimulus from all sources, which helps propel markets significantly higher off of its lows. But then recently, we've seen in 2022, when the Fed raised rates by 500 or more basis points on the short end of the curve, we had another 2-year recovery. Now, today, we're currently experiencing a drawdown. We have not gone back up above market highs, despite the recent rallies that we're seeing today in equity markets. How long will that persist? Well, we don't know, but we certainly want to give our clients the ability to stay invested because we're very confident that over the longer term, the markets will make new all-time highs. We just don't know when. Further, so if we're going to help our clients stay invested, it's probably wise to at least understand what they're paying to get into equities or what their valuations are if they're holding them. So I just looked at a couple of really high-level points here, and the point of this isn't necessarily for me to express an opinion on where I think valuations are either inexpensive or justified or expensive, but more so just to lay out a little bit of a framework of what today's landscape looks like. So I took the CAPE, S&P 500 earnings yield, core inflation, and the effective federal funds rate. Well, many of us will know that the long-term historic average for the CAPE is around a 16 to 17. Today, even after that significant pullback in the S&P 500 from earlier in the year, we're still sitting at around a 33, more than double the historic valuation, or certainly right in that neighborhood. So that doesn't tell us a whole lot as a standalone metric. Maybe there are reasons why the S&P 500 should be more expensive today than it historically has. So just taking this a little bit further, one of those reasons could be that margins are expanding and companies are simply making more money than they were in the past. So looking at the earnings yield on the S&P 500 at 3.57%, we can back into the implied PE ratio of what the S&P 500 should be given this earnings yield simply by taking 1 and dividing it by 3.57. And we actually do get 28, meaning that equities might be justified being significantly higher than their long-term average. But this 28 is still, double-digit percentage away from where they're currently valued at 33. So taking it a step further, well, maybe inflation is very low or the cost of capital is low. Both of those things haven't necessarily been true either. Right now, the inflation rate's at 2.79%, which is certainly a far cry from where we were just a few years back, upwards of 9%. But it's not tremendously low either, still significantly above the long-term target for the Federal Reserve, which is, of course, 2%. And then we have the effective federal funds rate, which I consider the risk-free. So I'm not even using the 10-year as the risk-free, where at least you're taking on some duration risk to get that yield, but more so the shortest end of the curve. And that's at 4.33. So one way to look at this is essentially to say, well, if I'm getting a 4.33% in the risk-free and the S&P 500's earnings yield is only 3.57 and valuations are high, why would I continue to hold equities instead of buying something I know I can't lose money in, or it's very low probability that I will? And finally, because this stuff is a bit of a snoozer, the real earnings yield on the S&P 500, so simply taking the effective the earnings yield minus the effective federal funds rate or the risk-free, and you actually get a negative number. So pretty much investors aren't getting paid a whole lot, at least mathematically, to hold equities going into the future. Now, again, this is not necessarily an opinion on where I believe valuations are. You can certainly be in the camp that you think something like artificial intelligence is going to significantly increase productivity for corporations throughout the S&P 500, improve their efficiencies, and cause margin expansion. Then maybe valuations should be greater than they were historically by 2x or more. Or maybe you think energy costs are going to come down and help improve margin expansion. Or maybe you think the Fed is going to be lowering rates 2 or 3 times this year, or whatever it is. But as a snapshot from where we are today, I think it's certainly fair to say that at least based on historical averages, valuations are a bit stretched. Because of that, I think that's why we've seen a lot of volatility once we had more uncertainty thrown into the mix from Washington with all of the tariffs, kind of throwing a wrench in people's valuation models and how they're perceiving equities and what they're paying for them in today's market. And then I looked at a technical indicator. Now, this one was a little bit more interesting to me, and it might just be because the name is so provocative. But I'm not sure if anybody on the call is familiar, I'm sure some are, with the death cross. Now, the death cross is essentially when the 50-day moving average crosses below the 200-day moving average for a particular stock or indice. And for this case, I looked at the S&P 500. Now, a couple of caveats with the death cross. Of course, the 50-day moving average is going to have more bias towards recent price movements because it's looking at a shorter snapshot of time. So it will move a little bit more when volatility picks up. And certainly when downside volatility picks up, this is a lot more probable. So I observed since 1995, over the last 30 years, which is the trend that we look at here, measured risk, we've seen the death cross happen 8 different times. So that's interesting. And most of these years were negative calendar year returns for the S&P 500, with the exception of 2. Again, that one anomaly year I mentioned with all the stimulus coming out of Washington and COVID, where the S&P returned north of 16%. And then in 2011, which was a pretty muted year for the S&P 500, where it returned just over 2%. But the average calendar year return in the periods where we've observed this technical indicator, the death cross, it's been negative 8.3%. So with valuations being a little bit more stretched, at least compared to their historic averages, and observing a pretty compelling technical indicator, maybe we should do a little bit more digging on how they relate to one another. So anyway, I looked at a little bit further about when we observed this death cross in a particular period, what that meant for potential future declines, how long these declines occurred, and then what the average peak to trough drawdown was for the market over a rolling 12-month period from the death cross. Well, the average drawdown we've seen from when the death cross is first observed, so after some recent price declines, death cross is first observed to the market bottom, has been 19%. The worst, which is going to be common, occurred in 2008, which was 53%, and the shallowest drawdown was in 2015, where the market finished pretty much flat at only 5%. Well, the time that it takes might be a better indicator of saying, hey, are we getting close to at least historically the amount of time it's taken to get to the bottom of one of these more volatile markets when we've observed this indicator? Well, there's not much help here either in terms of making portfolio decisions. We've seen the average time to the bottom, 79 days, so about a quarter. The longest time, again, in 2008 was over or just about 2 years. So we observed this indicator, which tells a lot of at least market technicians to get out of the market. In 2008, it would have been a great play. In 2020, however, it would have been extremely unfortunate because we only observed the death cross to the bottom of the market in just 3 days, given the swiftness of the decline. And over this 12-month period when we've observed this indicator, the average drawdown, peak to trough. Now, remember, the peak of the market typically occurs before we observe the death cross because of the bias towards recent price movements. But the peak to trough drawdown in the S&P 500 on average has been 29%. Well, this year we've seen about a 19% drawdown in the S&P 500. The worst being 56, again, 2008, and the best or the shallowest being 12% in 2015. So what does this tell us? Not a whole lot. It can take a long time or it can not take a long time. It can be very steep decline or it can be very shallow. Where are equity valuations? They could be overvalued. They could be valued appropriately. They could be undervalued depending on your disposition about the future expectations of the market. So for these reasons and the vast degree of uncertainty that investors are experiencing today and a lot of the anxiousness surrounding the volatility, we've seen a particular ETF asset class explode in fund flows. I mean, really impressive stuff here, namely the defined outcome ETF category. Now, at Measured Risk Portfolios, Synth-Equity is an options-based ETF like these defined outcome ETFs. And Larry's even mentioned in the past, we smell the same barbecue, but it's a little different recipe. We like to call ourselves a defined downside ETF as opposed to a buffer ETF. As many people know, buffers, typically they'll provide some upside participation to a cap in exchange for some downside protection to a buffer. Normally 10, 15, or 20% in either direction, depending on the particular strategy you buy. But in terms of the growth of this particular asset class, over the last 5 years, it's grown by nearly 400% to where it's at today at $61 billion in AUM. Now, that grew from 16 billion. So while still relatively small in comparison to some other sectors or strategy types that are out there, the growth can't be ignored, and it's only continuing to move in this direction. Today, there's about 379 of these ETFs, and new ones are being issued consistently on a daily basis from the First Trusts, the Innovators, the Alliances, and others that are participating in this particular market. So a little bit about these defined outcome ETFs outside of just having a buffer and a cap. They're passively managed. They essentially set a trade for a 12-month period. And intra-term, you might experience some volatility that's similar to the market, maybe a little dampened, but you need to hold it to term for that full 12-month period to realize the full buffer protections or get the full upside cap. And additionally, these aren't actively managed. So the risk profile of these strategies is always changing based on what the market's doing. For example, I noticed one particular buffer ETF last year, which had about $1 billion in assets under management. And it expired, or the maturity was in January. And it already had hit its cap by about Q3, meaning that there was no more juice left that investors could have made if the market continued to go higher. But there certainly was the potential to give back some of the gains over the next subsequent months should the market have rolled over. At Measured Risk Portfolios, we think our active upside management helps maintain asymmetry in our risk profile by constantly taking those profits in rising markets, putting them back in treasuries, and then resetting the options risk for following 12 months. So we are different than these buffered ETFs, although we are built using similar components, which is options on the index itself. And then one step further, before I turn it back over to Larry a little bit to talk about exactly how we run the strategy and what investors can expect with Synth-Equity, there's been some pretty big publications or some pretty big firms hitting the news lately with some headlines from AQR and BlackRock specifically about the buffer ETF or defined outcome ETF market. Obviously, two very well-respected firms, but two very, very different opinions. So AQR essentially suggests that the promises made by these buffer or defined outcome strategies is failing to deliver. That if you would have just went out and held a passive index, let's say the S&P 500, and a basket of treasuries, that your performance would have been better than going out and buying these buffers and paying the management fee. Maybe there's some merit to that. However, the S&P 500 has had two pretty great back-to-back years, which are far exceeding many of the caps. So maybe a short time window, maybe justified. You can decide. BlackRock, on the other hand, believes that this asset class is going to explode to $650 billion by the year 2030. So just over 5 years, we're going to see some pretty incredible adoption of these types of strategies due to their ability to really overcome the behavioral biases of investors, providing some comfortability in that they know to some extent that they have protection in their portfolio and they'll still get some upside participation based on the market's returns. Now, what's not mentioned, and this is why I humbly believe that Synth-Equity is a huge disruptor to this asset class, is a structure that can provide the uncapped long-term compounding returns that the equity market has historically delivered, but do so with not a buffer, where if you break through the buffer in one of these years, like a 2008, for example, you're still left with the unknown. The question that Larry mentioned, what's the worst this can get, simply cannot be answered with these products in those types of markets. But instead, it can be with a floor. So we think Synth-Equity leans in to both of the critics and the champions of the defined outcome strategy by producing a product that represents the best of the markets where we can get that upside potential, but simultaneously can overcome those behavioral biases by being able to provide greater confidence in the worst case scenario for the recommendation. And with that, Larry, you want to just go back into a little bit high level and go into how we build these portfolios and how they operate?
Sure, absolutely. So what we're looking to do with this structure is, again, we've decided to kind of restructure the teeter-totter, right? So instead of having a fulcrum maybe in the center or close to center, whether it's 50-50 or 60-40 or 70-30, we're actually moving it all the way out, let's say hard right, and getting a huge allocation relatively to treasuries. And that is going to be a kind of just a completely comfortable ride. There's no discernible volatility in this basket. Even this last I think about 2 weeks ago, Alexander, wasn't there some kind of treasury debacle on the auction on the 10-year or something where it got a little sticky? I think the treasury basket that we hold may have wobbled about 4 or 5 basis points. So something like 3 to 4 hundredths of 1%. was the amount of response to that. And that all kind of went past us. So we really anticipate that the treasury component of this portfolio is today the safest place we can invest. I mean, we were talking about this earlier. There's a risk involved in being in cash because your buying power gets eroded every day. There's a risk involved in being in equities because of the risk of loss and potentially a catastrophic loss in equities. And we have to be fair, there is a perceived risk or a risk in being in treasuries because there's always a chance that something catastrophic could happen to the government. But given the risk we have that we face today, this 1 year duration maximum, but basically a 6 months effective yield on the treasuries, is pretty much the safest place we can go for capital. So that is the anchor of the portfolio. I don't care what else you invest in. Tell me how you're going to assure a client that you have a safe place to be, except for that. I mean, that really is the whole point, is that there shouldn't be any anxiety in the majority of the portfolio. So we have that. That's our anchor. Once we get our arms around that, and this is not a complex part of the portfolio. This is the four quarterly maturities that we get a shot at re-rolling the exposure every 90 days. And we have a big chunk of capital coming due every 90 days to potentially re-risk the portfolio if need be. So that's the anchor. That's the big piece of it. Now, how on earth are we going to get that portfolio to move, or at least the objective to move along with the S&P 500, which is comprised of 500 equities? Well, we do it through this purchase of calls. And the calls are designed to lever up the return in that small allocation so that those options are moving at a pace roughly 8 to 12 times as fast or as hard as the S&P 500 moves on a daily basis. That's the structure. So, S&P goes up 1%. We're kind of hoping that our options go and gain in value about 10%. If the S&P drops 2%, we would expect to suffer a loss of something like 20% in the option component. And that's what makes it possible for this small little engine to drive the whole portfolio roughly in tandem with the S&P. That's the structure. What's unique for us is that over time, instead of just allowing capital to grow and continue to have all of our chips on the on the craps table, as use an analogy, what we're doing is, in the first example here, if we buy call options for a discrete defined amount of the portfolio, and then the market does appreciate, those call options are likely to participate and move up in value. And when they go up in value, we'll take an opportunity to sell that particular call option tranche and take the gains and add to the treasuries. So you can see in our graphic here that the harvested profits are reinvested into the short duration treasuries, and that raises the bar on what future damage can occur to the portfolio. Now that part is where we are, I believe, today unique in the marketplace. That's not being done in any other method that we're aware of currently. There are products that reset on a systematic basis, but they don't pay any attention to where they are in the cycle. They could be underwater or they could be positive, and they just do it because it's March 31st. They don't do it because of any kind of response to markets. So that's our understanding about where we are and what sets us apart. Now that is going to be to the upside, but we also have potentially a downside event. So it's not impossible that we buy options and that we don't get an opportunity to monetize those options. When that happens, it's because we do buy a significant amount of duration on our option contracts, typically as much as a year, but that doesn't mean we're going to get a return over the course of a year. So if the market doesn't cooperate and we don't get an opportunity to monetize those options, then we will let them expire worthless. And that expiration to worthlessness is where we hit our floor. And so the floor is not generated because we're buying puts. The floor is not generated because we've sold out of our exposure and gone to cash. Our floor is generated because our treasuries are expected not to lose money. In fact, they're actually gaining along the way. And our options, if we don't get a market movement underneath it, will be held to expiration and expire worthless. When that happens, if it happens, then we need to go into the treasuries and re-risk the portfolio. And that's what we'll do. So the reason we have this big basket of treasuries is to give us the dry powder we need to be able to go in and re-risk the portfolio. Now, if that happens, it's possible it can happen sequentially. So there's nothing preventing the portfolio from having back-to-back years that are negative or back-to-back duration that is negative. But that mercifully, is not the common pattern in the S&P 500. We typically have very strong performance more often than we have declines. So that's the structure.
And Larry, I'll actually touch on a little bit about the S&P 500's recent performance in a coming slide. But one of the things, or two of the things rather, that I find so compelling about this portfolio is the goal of the strategy is to accumulate more money into the relative safety of short duration treasuries than an investor's entire account balance at inception. So with the ETFs today, let's say it's trading around 25 and you can assign a certain percentage of that to our allocation to short duration US Treasuries. Well, after some very strong market performance, we anticipate the percentage of the NAV allocated to short duration US Treasuries to be above that $25 mark. And this way, you're in a position where even if you do experience, or we all experience, a very swift equity market decline, you can't go backwards, at least not for that rolling 12-month period. And I just think that's so compelling because markets do typically go up more than they go down. But Larry, maybe you can shed a little bit more light on exactly how we back into buying these options using Delta. And what I find really interesting about this product is that in rising markets or in very strong markets, we have the potential to outperform and look like a large cap growth fund with this, allocation to call options and treasuries. However, in a falling market, while we might look just like the S&P 500 for the first couple percent of the decline, our losses get softer and softer to each leg lower. And it's really a factor of delta, or the rate of change of the options to movements of the underlying index it's tied to or security it's tied to. Would you mind talking a little bit about how we construct a portfolio using delta and what that means?
Yes, but I'll try and use English instead of Greek. So because at the end of the day, I am still a planner and an advisor in that role. And I don't have the CFP designation. I have a CLU and CHFC, which is the planning side of things. And so what my observation when I first started to look at options as a way of managing risk is that it is so intimidating. Oh my God, the type of language that is used and that the trainers use with delta and theta and rho and gamma and all these things that we measure as a way of trying to appreciate how an option might respond to the movement of the underlying is pretty daunting, frankly. I'm here to tell you, you do not have to know how this works. You don't have to be an expert in delta or an expert in theta and understand how much gamma we have in the portfolio. What we have to rely on is more like, I think it was Archimedes, right? With the lever, right? But given a long enough lever, I can move the world. And that is what we're really doing here. The idea, though, there is an important thing that Alexander mentioned, and that is delta. And delta does relate to how much movement can we expect out of an option given a movement of the underlying security that the option is tied to. So if let's just say the S&P 500 is trading at 1,000 and it goes up 1% to 1,010, then how much would an option contract move given that 10-point move? Are we going to get 10 points of movement? Are we going to get 5 points of movement? Or potentially are we going to get more movement? Well, it's not possible for a single option contract to get more movement than the underlying security experiences. You have to over notionalize the contracts. So if one contract might move with a delta of 1, which is unlikely, just for argument's sake, in order for it to get more than the movement, you'd have to have more than one contract. So mathematically, we just increase the number of contracts. Delta for us is typically adjusted by buying more contracts to adjust up that delta and increase the potential response to the market. But here's an interesting thing that happens. As the market rises, delta starts to increase. So the delta is going to rise from, say, 0.5 or 50% at the money or near where the strike is relative to where the market is at the price. And it starts to rise to 55 or 60 or 65 and 70 as the market's rising. So if we have a delta that's been adjusted and the market is rising, what we start to do is position ourselves to earn more than the underlying movement of the market on a day-to-day basis. And that is effectively our trigger. And the thing that we're monitoring is how much more are we earning than what the market is earning before we will sell that option and take the gains and reset ourselves back to a strike level that makes sense to try and maintain participation with the market. So that's one of the things we monitor. The second thing we monitor is absolute risk. So if we're trying to keep our losses to something around 15% over a rolling 12-month period, we really don't want to get into a position where we have 22% of the portfolio in options, because we know that at any moment, the market can turn around and go negative. And as we've all experienced recently, when it wants to go negative, it can go negative in a hurry. And so we want to make sure that we're not too far over our skis in the actual physical allocation to options. So that is the structure to the upside. Another wonderful benefit of the way that the delta responds to the market is that just the corollary, the inverse, when the market's rising and delta increases, the participation rate to the movement of the market increases. On the way down, delta decreases. So it's a self-governing response, because, and you think about this, as the option component starts, let's say just mathematically at 10%, and we have some losses and it drops to 8%, well, there's less of it relative to the overall portfolio. There's less of it to lose, right? So as it goes from 10% to 8% to 6% to 4%, the impact on the portfolio is going to get smaller and softer and softer and smaller. That is just math. It's math that's doing this. It's not, frankly, the trader's skill or some sort of trend following thing or some sort of anything else, frankly. It's just math. And it's the math in response to the market movement that makes this such a reliable method to manage the risk that's in the portfolio and measurable. So this process, allowing the options to soften up, still doesn't mean that we're out of the game. When the market went through its gyrations in 2020, those options took a tremendous loss, and they lost nearly all their value in the early part of March, toward the middle of March of 2020. And then we had a just unbelievable fast recovery. And so the experience for this type of portfolio, the structure was that the options stopped participating in the losses on the way down and then rebounded and picked up participation just a few months later. And that is what we expect from this, is the ability to still be positioned for participation in a potential recovery, as long as that recovery occurs somewhere within 12 months. If the duration of the decline is longer than that, then the options don't get a chance to make it out the other end, and we have to repurchase the options, as we've illustrated here.
Yeah. So that's really interesting. And when we repurchase, this strategy will always be positioned offensively. And as you mentioned, it is just math, meaning that you can more clearly define how you anticipate this portfolio to react within some margin of error. So just recently with the Synth-Equity ETF, we launched on March 10th, struck an NAV on March 11th, and we had some pretty volatile markets over the last 6 or 7 weeks. Well, as you'd expect, the first couple of percent of the decline in the S&P 500, Synth-Equity also declined just as quick, if not slightly quicker than the market. But as the market continued to fall over this roughly 14+% decline in the S&P 500, we only had a downside capture of about 70%. Should the market have continued to decline, our downside capture would have actually fallen, depending on how far the S&P 500 fell. So at any one time, and the holder of the ETF could have just went on synthequityetf.com, looked at our holdings, looked at how much percentage we had in options, made an estimation of how much yield we were going to get off of the Treasuries, added them up and said, okay, between now and the contract expiry, which is currently March 20th, 2026, my floor on losses is approximately this. And that's certainty and confidence that we don't find in very many investments, and certainly not those that have at least the potential to outperform the index itself. In terms of how I'm working with a lot of advisors to incorporate Synth-Equity, again, I look back at this 30-year performance of the S&P 500. So essentially, this chart on the y-axis is frequency of return, how many times we observed a particular return in the S&P on a calendar year basis. The x-axis is those intervals at 5% buckets, from -35 to -40%, all the way to +35 and +40%. And immediately something jumps out at you. It's that if this was a distribution curve, it is clearly skewed to the right tail, where the S&P 500 goes up a lot of the time. In fact, the most common return that we see, common return frequency we see is between 25 and 30%, which has happened 6 times over the last 30 years. Now, to the left tail, we see 6 years when the market either returns 0% or less. We bucket this out into 2 categories, affordable losses and catastrophic losses. We call this 0 to 15% loss bucket the affordable loss range because of the mathematics of gains and losses. 15 or 56% of the time over the last 30 years, the market has gone up 15% or more. And based on the mathematics of gains and losses, if we limit our losses in Synth-Equity to 15% or less, then that means even if we suffer a total loss in the options in a negative year, like a 2022, the probability of recovery the following year is quite high. Compare that, as I mentioned earlier, to traditional equity investments that could fall 20%, 30%, or more when you have these very long recovery windows. Because as I'm sure many of us know, if you fall 10%, you need 11% to get back to break even. If you fall 50, you need 100% to get back to break even. Well, the market returns more than 11% a lot of the time. So that's where we'd like to risk our clients and our investors, where we have the higher probability of success over shorter periods of time. But in terms of incorporating this into a portfolio, particularly for those that might be familiar with other options-based solutions like the buffer products. And I know a lot of smart advisors that allocate to these products and their clients love it, but we feel we can make a case to potentially improve the expected return of these products while adding greater certainty and stability in the very worst market declines. Now, on the right tail, these very strong years of equity market performance, Synth-Equity, because of its uncapped upside, because we're always taking profits and using this delta adjusted method, can get exposure and has the potential to return 35% in a year when the S&P 500 returns 35%. Simultaneously, to the left tail, where the buffers will start to participate and take material principal losses below their buffers, all the while being very volatile until their maturities. Synth-Equity will floor out, where we'll be 100% allocation to Treasuries, and we'll be providing stability to potentially a model portfolio. And then we have this affordable loss category. Well, Synth-Equity will take losses if the S&P 500 is down, say, 10% on a year, and we didn't have ample opportunities to harvest profits before experiencing this drawdown. Well, in this environment, which isn't great for Synth-Equity, while it doesn't happen often, the buffers will actually return likely 0, given the typical buffer structure. So in the left tails, we can support the portfolios. In the right tails, we can improve the expected return. And in that one not so common scenario that's not great for us, we actually can get supported by that. So in terms of how it's used in complement with other options-based strategies, that has been the method that I've seen a lot of advisors gravitate to. Now, if you're not familiar with options-based strategies and still find our particular investment approach interesting, consider a core equity allocation. If you can potentially get your clients similar upside as the equity market, but then still provide some stability in those down markets that traditional equities won't provide, it can be a very compelling pillar. I like to say it's like the elevator shaft in building a skyscraper, where you can build out all of the things around it, even potentially if those things have greater volatility, because you know before entering this investment what the worst case scenario is. It's clearly defined based on our percentage of risk and options. Now, a little less common, stands to reason that some investors do believe that bonds carry a double-digit risk. That's up for you to decide again. And if you do believe that bonds have the potential to fall 10 or 15% in a year, considering that we are 85 to 90% short duration US Treasuries, one interesting idea is if you have a portfolio of, say, 50% stocks and 50% bonds and cash equivalents, by allocating that 50% to bonds and cash equivalents to Synth-Equity, effectively, you still have 44% of that 50 in bonds, and you have about 6 to 7% in options. So as a total portfolio, your portfolio can move with greater upside than just that 50% allocation. And we touched on some of the performance of that portfolio earlier. So it is a Swiss Army knife. Depending on your practice and how you allocate capital, it can be used in a number of different ways. And we're certainly at the ready to help walk investors through additional education if it's needed, or just help them understand where it might best fit in their portfolios based on our experience. But Michael, I think that wraps up a lot of the meat and potatoes of what we were aiming to cover in today's call. Do you want to maybe answer any questions that you might have thought of, or open it up for Q&A to the audience?
Yeah, no, I mean, certainly you launched at an interesting time, especially given the volatility. I was looking actually as you guys were chatting at the performance in the midst of the tariff volatility, and you can clearly see the outperformance against the S&P. All right, so is it fair to say that if we're in a cycle of more of these pulses of volatility, that the cumulative compounding effect of that is actually very beneficial for the fund?
Interesting, but probably not. Well, really, it's more like a self-repairing airbag. You know, we're not getting extra mileage by having that airbag go off, but we're consistently not going to suffer a drawdown that's going to exceed our budget, really, no matter what comes at us. That's our belief, right? So if there is some other type of development, either politically or maybe active nature, California slides into the ocean, something dramatic and terrible, you know, the main thing that we like about the structure is it's meant to be resistant to whatever. I mean, none of us know what is going to be the catalyst for a 50% decline in the S&P 500, but also none of us can assure ourselves or our clients that it won't happen again. And so because we have that near and present risk, and I think that's what gets everybody on edge, is that sort of fear that the first 8% could just be the first 8% of, you know, potentially 30 or 40% more to go. That's what this product is really designed to prevent, and prevent it mathematically. Volatility is not our friend. We are not, you know, trading on vol or doing any type of structure that allows us to amplify that. What we're doing is putting ourselves in a position where we just can't suffer a loss greater than what our risk budget is.
Yeah, and that matters quite a bit, obviously, in terms of cutting off the tail risk. So that makes a ton of sense. For those that are on this webinar, again, I will be emailing for those that want to get CE credit. So you'll get that from me, so I can make sure that's submitted to the CFP board. I think this is a very interesting product. Alex, Larry, for those who, since you already mentioned it, for those who want to maybe more directly reach out to you, that have questions, how should they go about that?
Yeah, they should reach out to my email directly. It's alexander@mrpfolios.com, or reach out to us on LinkedIn, visit our website, give our office a call, you know, whatever works best for you. We're stand ready to help you out.
Yep. The good news now that you can just Google Synth-Equity up there and it'll take you to many places where you can find us.
Appreciate everybody that watched this. Again, I'll make this an edited video available on the YouTube channel soon enough, and hopefully I'll see you all in the next webinar. Thank you, Larry. Thank you, Alex.